Most property buyers in Australia are solving the wrong problem and it's costing them years. Let me start with something I see constantly in this space, and it genuinely frustrates me. Not because people are doing anything wrong, but because the system they're operating in is set up to keep them stuck. Someone decides they want to invest in property. Maybe they've been thinking about it for a year, maybe longer. They start doing what you're supposed to do. They research, they read articles, watch YouTube videos, download suburb reports, build spreadsheets, consume every piece of data they can find about capital cities, regional markets, yield versus growth trade offs. They're genuinely working hard at this. 6 months later, they're still researching. And here's what I want you to notice: the problem wasn't a lack of information. They had plenty of information. The problem was that all of that information didn't add up to a decision because they never built the framework that would allow them to evaluate it. They were solving the wrong problem. They thought the problem was, I don't know enough. The actual problem was, I don't have a structure for making this decision. That distinction matters enormously because those two problems have completely different solutions. If the problem is information, you need more data. If the problem is decision architecture, you need a framework, and no amount of additional data will substitute for it. So today I want to walk you through what decision architecture actually looks like in property investment. Not the sexy stuff, the structural stuff. The thinking that separates buyers who actually build portfolios from buyers who read about portfolios for years and never move. I want to break this down into three components, and I want to be clear that these aren't my invention. They are patterns I've observed across genuinely successful long-term property investors. The ones who didn't just get lucky in a rising market, but who build positions that held through cycles. The first component is separating the property decision from the lifestyle decision. This sounds simple. It isn't. Most people who are starting their property investment journey are simultaneously thinking about where they want to live, where they feel comfortable, where their network is, where they understand the local market. And there's nothing wrong with those considerations for an owner occupier purchase. But when you're building an investment portfolio, those emotional geographies and the structural case for capital deployment are often completely different things. The investors who decide to buy in their own suburb because they understand it, because they can drive past it because it feels comfortable. That investor is not necessarily making a bad decision, but they are making a decision that's driven by familiarity rather than by the structural demand indicators that actually support long term asset performance. What do I mean by structural demand indicators? Things like, what's the employment base in that area? How diversified is it? Is there genuine population growth that's likely to persist over the next decade? Or was it a temporary uplift? What's the rental market depth? Meaning, how many potential tenants are competing for that type of dwelling at that price point? And critically, what constrains supply? What stops the market from being flooded with new stock if prices rise? Investors who separate the lifestyle decision from the investment decision can look at those indicators objectively. They can buy in a city they've never visited, in a suburb they don't instinctively feel attached to, because the structural case is sound. That psychological flexibility is a genuine edge. The second component is knowing your actual financial position before you start looking. I'm going to be specific here because get your finance sorted is advice so generic it's almost useless. What I mean by this is you need a current, fully assessed borrowing capacity figure from a broker who has actually looked at your income, your liabilities, your expense profile, and the type of property you target. Not a rough number, not a back of the envelope calculation, a real number. And that number needs to take into account the specific property type you're pursuing because lenders assess risk differently across different property types and locations. A high density apartment in a major CBD has different LVR constraints than a house in an established regional city. Those differences feed directly into your deposit requirements and your holding cost structure. Why does this matter for decision architecture? Because without a clear financial position, every property you look at is evaluated against a hypothetical. And evaluating real assets against hypothetical financial positions produces a kind of permanent uncertainty. You can never quite commit because you're never actually sure if the numbers work. Getting a real current assessment resolves that uncertainty, and gives you a genuine baseline to make decisions from. If you're at that stage where you're trying to get clear on your financial position before you move and you want a structured conversation, that's exactly what our discovery calls are for. No obligation, no sales pitch, link in the description below. The third component is defining your exit condition before you enter. This one is counterintuitive. Most people think about what they hope a property would do. They don't think carefully about what conditions have to be met for them to say yes. Those are different things. An exit condition, or more accurately, an entry condition, is a set of specific predefined criteria that a property has to meet before you'll commit capital. Not I want good yield and growth potential. That's a wish list. What I mean is yield must be X% or above. Gross rental income must cover 5% of holding costs. Vacancy rate in that submarket must be below Z. Land component must represent at least this proportion of total value, and so on. When you define these conditions in advance, you do something very important. You remove the negotiation that happens inside your own head when you find a property you like. Because emotion is a variable in every property purchase. The beautiful kitchen, the good vibe from the neighborhood, the agents who's personable, those things are real influences on your judgment. And they don't all point in the right direction. Predefined entry conditions act as a circuit breaker on that emotional response. If the property doesn't meet the criteria, the answer is no, regardless of how it feels. If it does meet the criteria, the answer can be yes, and you can move with confidence. The investors I've seen build strong portfolios are almost universally the ones who got disciplined about this early. Not because they were emotionless, everyone has emotion in these decisions, but because they had a structure that could hold the weight of that emotion without letting it override the analysis. Here's what I want to leave you with from this video. The Australian property market will present you with information indefinitely. It will present you with opinions, with hot takes, with suburb reports, with interest rate commentary, with predictions about what's going to happen next. That information is not going to stop coming, and more of it will not make the decision clearer. What makes the decision clearer is a framework, a decision architecture that tells you what you're looking for, validates your financial readiness, and defines in advance what a yes looks like. That's the game, not more research, clearer thinking.